Hello class, we're going to work on chapter 10 today, which is property, plant, and equipment. Now, we've got several little topics, but they're not all equal, of course. So we're really going to cover, in this video, cover two things. We're going to cover, hey, when you buy property, plant, and equipment, then you're going to capitalize that cost of anything that it takes to get the asset into its operation, into place, ready for its intended use. Now, there's some good exercises in the book, and basically anything that's involved with getting the asset ready to use is a cost, and to capitalize just means to debit the asset account. So it's not an expense, it's an asset. So we're going to spend some time. This is our big problem in chapter 10. You haven't seen a problem like this before, like in financial accounting or anything. And then we'll the second video, I think I can do all this in the second video. We'll do these items. We'll probably do a second video that relates to this interest capitalization. So let's talk about what that is for a second, and we'll get going on the problem. So here is kind of the outline, and down here we're kind of going through the material a little bit. So the cost of property, plant, and equipment is capitalize all costs necessary to place an asset into service. So it's the cost plus the freight plus insurance, installation, attorney fees, closing fees, taxes, on and on and on. Okay? Now, this topic is called interest capitalization. So let's say that you're building a building, and generally this is what happens. If you're building a building, let's say this building takes a year and a half to build, and so we've got construction expenses. So the first thing we want to do on this problem is we need some information. So here is everything that's highlighted in this green color is basic information. It says, hey, we have construction expenditures. We have signed a contract. We're going to build a building, and we have to make payments over January through April of the following year. So we're required to make a payment of $500,000 on January 1st, and then $400,000, and then $600,000. So a total for 2016, we're making $1.5 million. And then in January and April of the following year, we're making another $900,000 total. So the total cost of our building is going to be the $1,500,000 plus the $900,000. But we have some interest cost, and so we're going to add the interest cost that is necessary to do this. So let's say we took out a one construction loan for $1 million, and it's at 8%, and it's going to last for this entire period. And we have two other loans. We have a long-term note at 6%, and we have an equipment note specifically on equipment at 12%. Okay? So the first thing we're going to do is we're going to calculate something called the weighted average accumulated expenditures. Expenditures is a fancy way to say cash payments. So expenditures is not an expense. What is the weighted average accumulated expenditures? Now, this little paragraph, basically, here's what I want you to think about. I want you to think about the interest formula. The simple interest formula is principal times rate times time. So what we're going to do is figure out the weighted average amount of expenditures, the weighted average accumulated expenditures. So we're going to come up with a number, and that's going to be our principal number, and then we're going to also take it times the months, so that will be the time, and we just have to figure out the rate. So if we took the principal times the time, then this is what weighted average accumulated expenditures shows. So we're going to have to do a couple of problems before you're really comfortable doing this. So let's work this one, and then probably the second video we'll do another one. It'll take a little while because we got two parts on this one. So for 2016, we've got an expenditure of $500,000. So we're going to drop in, I'm going to drop in $500,000 here. And for March 31st, we've got $400,000. And for September 30th, we have a required payment of $600,000. Now, how many months for that year, how many months do we have? And I've already calculated the fraction, but this is going to be for a full 12 months. March 31st, you're missing January, February, March. So what you have is 9 months. And then September is the end of September, so you've got October, November, December. So we're talking about 3 months. So what we're going to do, remember, we're taking the principal times the time. So this is the principal times the time, the fraction. And we're going to multiply this out. So we're going to say 500,000 times 12 divided by 12. So that's 500,000. That is 12 divided by 12 is 1, so 500,000. But you'll see what happens is the weighted average will go down. 400,000 times 9 twelfths gives you 300,000, and then 600,000 times 3 twelfths gives you 150,000. So even though we made payments of $1.5 million, the weighted average of this, based on the time, is going to be 950,000. So the first step is we're going to calculate the weighted average accumulated expenditures of 950,000. Now that's our first calculation to calculate how much interest we're going to add to the cost of the building. So we've calculated the weighted average accumulated expenditures. Now, the first step was to find the information. Second step is to calculate a weighted average. This is an important number. And in fact, we're going to drop this number in on this calculation. We're going to say, we're going to calculate the potential interest to be capitalized. We're going to put the weighted average accumulated expenditures, the weighted average expenditures here, as the funds borrowed. So we're going to do basically a what if. What if we had borrowed that money, and we had borrowed that money using the construction loan? Well, how much was the construction loan? The construction loan was $1 million, so it completely covers the 950,000. So we're going to take the 950,000, we're going to just drop it here, and there's no more left for other loans. So we don't need any other money for other loans. Now we know the interest rate. The interest rate for the construction loan is 8%. So I can take 950,000 because it's already principal times the time, and just multiply times the rate, and we'll get 950,000 times the 8%. Now, what is our amount of interest for the other loans? Well, we don't have to have that right now. We'll do that here in just a minute. We can plug that number in, that interest rate. We need to calculate what's the weighted average interest of the other loans. But here, we know that 0 times whatever this number is going to be 0. And so therefore, we can add this up. It's going to be 76,000 is what we call avoidable interest. So we're going to calculate interest two different ways. We're going to say, what could we have avoided? Well, if we had not taken out the construction loan for 8%, and instead we had paid the 950,000 on the loan, we could have avoided, put it this way, if we'd have paid off the loan rather than paid off the construction company, we could have avoided $76,000 of interest. All right, we're going to calculate the average interest on the other loans. So we have other loans. We need to figure out the rate and the period covered and everything. We have a $2 million loan that is at 6%. The rate is 6%. It's for a full 12 months. We have a $4 million loan, and the rate is 12%. So we have a loan, combined loans of $6 million. If we calculate the interest, then this $2 million times 6%, we don't have to multiply it times 12 over 12 here, then that's $120,000 of interest. And the $4 million loan times the 12% is going to be like $480,000. So what we have is a total interest. The average interest, the interest is 600,000. So we're going to take the 600,000 divided by the 6 million. 600,000 divided by the 6 million. And we're going to say, hey, it looks like the average interest rate is 10%. So we would put this number, 10%, right there. If we had any calculation, if we had 100,000 for that loan, then we would calculate that as part of the avoidable interest. Now, because this construction loan is $1 million, we only need 950,000. If the weighted average was 1.2 million, we'd need 1 million here and then another 200,000 there, and it would change our avoidable interest calculation. All right, so we've calculated the weighted average accumulated expenditures. We've calculated the avoidable interest, and we had to calculate the interest rate for the other loans. This is really the weighted average interest rate. And we're going to compare this to actual interest. So step number 4, let's compare this to actual interest. So let's plug in what we know. Our construction loan was 8% for the entire year. So it is 8% times 1 million. 8% times 1 million is 80,000. And then our long-term loan is 6% times the 2 million, and our equipment note is 12% times the 4 million. So we actually have actual interest. The actual interest is 680,000. So here is our last step for the year 2016. We're going to calculate interest, capitalize interest based on the lower of the actual or the lower of the avoidable. Okay. Now I just built a little formula, pretty cool. You can kind of go back and edit this and figure out, how do you do this? So I just grabbed the number. I used a text formula, put it together. So we have this here. We don't have to scroll back and forth. The avoidable is 76,000 and the actual is 680. We're going to capitalize the lower of the actual or the avoidable. So we're going to say, hey, the avoidable is 76,000, so our interest to be capitalized, the whole purpose of this problem is for 2016, we're going to take 76,000 of that actual interest. The actual interest is 680,000. 76,000 of it, instead of saying interest expense and cash, we're going to say building and cash. Make sense? Okay, we need to do the second part of this problem, which is the year 2017. So it's going to be a similar problem. We've got number 1, we've got all the numbers here. Go back and look at all the numbers. So we're going to look at this, and we still have all this down below. For the entire period, we have these payments and we have these loans. So let's scroll on down. So we're going to say, well, what kind of expenditures do we need to make? Well, our expenditures let's calculate, let's put a number here. Funds spent plus interest capitalization. So let's do this. We spent 1,576,000. We spent the 1 million plus the 1,500,000 plus the 76,000. So we have spent 1,576,000. So the funds spent in 20. So let me build this a little bit better here. So let's do this. Funds spent in 2016 plus interest. Make this a little bit smaller, maybe we can see it. Okay, the funds we spent in 2016 plus the capitalized interest, and we only have 6 more months. So we got 6 months to deal with in 2017. This loan, this construction we finished on the end of June, June 30th. So we got 6 months covered in this problem, but we've already spent this money. You can't forget about it. And so that number turns out to be 1.5 million plus the 76,000. So the weighted average accumulated expenditures is going to be the 1,576,000 times the 6 months divided by 12. So our weighted average number is going to be 788,000. Accumulated, remember it's weighted average accumulated expenditures. Now we're going to take the numbers we already know for January 31st rather, is the end of January 600,000 and the end of April is going to be 300,000. We've got 5 months left from the end of January. You got February, March, April, May, June, so 5 full months. You've got 2 full months, May and June. So we're going to calculate the 600,000 times the 5 months divided by 12. That's 250. We'll do the same calculation except 300,000 times 2 months divided by 12, so that's 50,000. So what we have, we're going to add up all these numbers, and we'll have the weighted average accumulated expenditures for 2017 is 1,088,000. The 1,088,000. Now, we need to plug in and figure out what's our avoidable interest. Our avoidable interest, we're going to put, remember, the 1,088,000 here. Now, how much is our construction loan? Our construction loan is 1 million. We can't go above 1 million. So that means we need the plug for the other loans is going to be 88,000. Right? So let me do the math on it for you. 1,088,000 minus 1 million. You see that. I'm just, when you go back and look at it, you can see my spreadsheet. I'll obviously share this spreadsheet with you. So the interest rate for the construction loan is 8%. The interest rate for the other loans, the weighted average interest rate is 10%. So that means our avoidable interest is going to be 1 million times 8% or 80,000. And then it's going to be 88,000 times 10% or 8,800. And we'll add this up, and our avoidable interest is going to be 88,800 is our avoidable interest. Now, remember, this is the same average rate. This 10% is the average rate we had for 2016. Still have the same loans. Now, we need to calculate based on actual interest. Actual interest. We're going to do the actual interest here. We've got the construction loan. We're going to calculate the 8% times the 1 million. So 8% times the 1 million is going to be the 80,000. We know that. Now, got to be careful. It's only 6 months of interest. So we're going to take the 1 million times the 8%. It's only from January through the month of June, 6 months. So we need to multiply this. This is times 6 divided by 12. Okay, so it's only going to be 40,000 interest for the 6 months. The long-term note is 6%. The equipment note is 12%. So we're talking about the 2 million and the 4 million. And we're going to multiply that 2 million times 6% times 6 divided by 12, and we should get 60,000. That looks right. We do the same thing. 4 million times 12% times 6/12. So we're only talking about 6 months. The period of the loan of the construction of the building is 6 more months in 2017. Add this up. The maximum interest. This is the avoidable interest, and this is actual interest. This is actual interest. So what is the lower of the avoidable. See the avoidable and the actual. The avoidable is 88,800. The actual is 340,000. So certainly our interest capitalization is going to be 88,800. How much interest do we capitalize for 2017? It's going to be 88,800. So the point of all this, and we generally, you kind of work the problem without showing an entry. So the point of all this, instead of having interest expense and cash, we're going to take what? We're going to take the 76,000 plus the 88,800, and we debit building for 164,800, and credit cash for 164,800. This is interest expense that is not expensed. It's capitalized as a cost of self-financing a building for 18 months. All right, that's how you do the very introductory problem, and this is kind of the big problem in Chapter 10, Property, Plant, and Equipment, is interest capitalization. So this is for long-lived projects like building a building is the best example. All right, thanks for watching.